very welcome to the latest episode of Informed Decisions 356. And we're going to talk about what to do, rather, if you're planning to retire this year. We're in January 2026. We are posting out our annual client letters, updating on investment performance over the past year and what to perhaps expect this year. Perhaps people are getting their ducks in a row and their finances in order for those that are retiring / exiting / moving to the next chapter this year. And so this week I'm going to share, hopefully concisely, details on what you could be doing, practical terms to prepare for same, basically. So this week I'm going to share how to check if you're realistically on track to retire in 2026, what pension and investment decisions to think about for this year, how to think about your retirement income needs for once you do exit employment, how to consider and also to reduce / increase investment risk as appropriate based on your plans and preferences, and what to do and how to get ready before discussing all of this with a financial planner. And on that note, I do think, and again, I'm biased, but I do think if you are planning to retire, you should absolutely speak to a financial planner, right? That's where they bring all of this data and your own preferences. So that hard and soft data, as I call it, combining all of that to actually create your financial forecast and tell you what you need to do to increase the probability of success for your exit and your future financial well-being. That's fundamentally what a financial planner, in my humble opinion, does or should do. That's what they should do. Based on all of that, there may or may not be a product that can improve your outcomes. There may or may not be. But if there is, they can show you how, or they should be able to show you how and what that will do to help improve the probability of success. That's the only reason that a product a product change should be implemented, in my humble opinion. So January is a great time to look at all of this, right? Some of us have New Year's resolutions or plans or campaigns or goals for the year ahead, or priorities or things that we want to keep in mind or proactively work on and think about. If retirement is one and exiting employment is one that's on your radar, then hopefully this will help. If you're a year or two away from retirement, I think it's critical planning and organizing kind of a window, personally speaking. And you can be your whole career building and accumulating, but when it comes to actually fully exiting, within a year or two is key to make sure that the ducks are aligned. And who doesn't love aligned ducks? It's a period to focus on pension contribution opportunities, investment rebalancing and alignment, income planning and cash flow forecasting. Income planning is wonderful to think about, okay, how are we going to actually replace the income that to date we've been earning? If I stop earning, how am I going to replace that income? And then using tax allowances and being tax efficient in the culmination of all of that. All right. So 5 numbers that you must know. Expected retirement income. So instead of focusing on how big your pension fund looks on paper, and let's face it, that will most likely change on a daily basis, start with the income that you will actually need / want after tax. So ask yourself, what level of monthly net income would feel comfortable? What lifestyle do I or we realistically want in retirement? And what will that cost? How much travel, leisure, family support and gifting, if applicable, do I expect to really do? And what will all of that cost? And for everybody, that is totally different. Many Irish couples will aim for somewhere between 3,000 and 6,000 net per month. And again, if you consider that the state pension could generate, if that was what one was relying on, depending if it was a couple, state pension might still fall short of that. So it's okay. These are aspirational figures for a lot of people. But if you were aiming for between 3,000 and 6,000 net per month, how close are you to that? And again, some will have lower, some will have higher aspirations and desires and needs. The important part, I believe, is choosing a realistic figure rather than guessing or just simply saying, well, look, up to now we've been earning, 10 grand a month net. So yeah, sure, look, give me 7 or 8 of that. Like, where's that? What's that based on? Okay, so lots about your lifestyle would change when you exit. Some of it meaning you will have an additional need for income. Some of it meaning you might have a reduced need for income. Do your numbers. Nobody else can do that for you. They can aid you, they can aid the conversation, but you've got to do that piece of work. So that's the first thing. What's the income you will need? Another thing to get ready and to clarify for yourself, ultimately, at this stage, and indeed for a financial planner, if you're going to engage them, is gather updated statements and investment strategies for any pension assets, any investment accounts, any other assets or investments, property, etc., that you own. When it comes to the pension side of things, so everything from PRSAs, company pensions, defined contribution schemes, defined benefit incomes that you might have from old schemes, these can be really, really valuable. AVC pensions, personal retirement bonds, buyout bonds, hopefully you have all of them collated somewhere. Like if you look at defined benefit schemes, many of us were members of defined benefit schemes in previous employments that were either ceased or wound up. So if you do have deferred defined benefit income, that can be wonderful. Like, you might say, it was only 5 grand or something. Bloody hell, if that's been indexed, in 10 years from now, for argument's sake, that could be very, very meaningful income. Might look like a relatively minor figure of 5 grand a year, for argument's sake, but that is going to be significant cash every month and significant inflows that need to be considered. So 5 grand a year, if it's a defined benefit, that could be worth 100 to 150 grand in pension pot value if you were to convert that to a DC or a PRSA income, or pot rather. So do that second piece. That's the second figure, your pension values. Figure out what it is and the investment strategy. Thirdly is your target retirement spending, right? This is closely linked, obviously, to one, but think about your actual retirement spending into categories. So it feels real rather than theoretical, as I said earlier on. Don't just pick a number. What are the fixed costs, such as utilities, insurances, and groceries, for argument's sake, which are big numbers for an awful lot of us? Keeping a car on the road, right? Motoring expenses, insurance, depreciation, etc. Then lifestyle spending, including hobbies and interests and holidays. This can often be as big as the fixed costs, aspirationally at least. It can be a big number. So again, it's about being realistic there. But what is that likely to be? What's the target retirement spending? Okay. A useful exercise can be, once you have established that, is to try and live on your planned or intended retirement budget for a month or two. Many people would be surprised at how different it feels when you know, okay, this is what we have. Based on the numbers, it could feel very comfortable, or it could feel, geez, that's a little bit tight now for my liking, right? It's a bit restrictive perhaps. So again, all of that is really useful exercise and planning and thinking around all of this. Number 4 is cash reserves. Before retiring or exiting from employment, most people benefit from holding cash reserves, a backup, a parachute, emergency fund, call it whatever you will, and maybe between a year or 2 years of expected spending at a minimum. Some people it's less, some people it's more, okay? But having that squirreled away, that's not earmarked for anything else, can be a very, very important psychological safety net, particularly if you are anxious are extremely worried about markets, about values, about your ability to do this. Having some backup there is important. Interestingly enough, if you way underestimate your retirement spending needs, and you end up spending an awful lot more, it is from this cash reserve pot that spending can be funded. And that it can be a dangerous thing, because if you're 2 years down the road, all of a sudden you say, geez, we've actually chipped into our cash reserve pot big time, and that's now gone down to a couple of months. That's when things can get a little bit tight. Again, depending on your outlook and your mindset around this stuff, that can get a bit tight. So it's important to get the other stuff right around your expected, as right as one can, around your expected expenditure, so that you can hopefully have this cash reserve pot for genuine, unexpected one-offs or needs or gifts, as the case may be. But it can help. Having that cash reserve, it can help big time. We know that markets don't move in a straight line. Things happen, unexpected expenses appear out of nowhere. It just helps reduce the financial stress and potential concerns big time. Fifth number to know, I would say, is your state pension forecast. You should check your PRSI contribution record to calculate and to confirm your likely state pension entitlement. Get the statement at very least. It's a big old list of numbers, may or may not mean a whole pile to you, or it mightn't be something you're interested in reviewing. Your financial planner will absolutely help calculate, in approximate terms at least, what it is actually means and what your entitlements would be based on what you have contributed PRSI wise to date. The full amount may or may not be available to you depending on your career and your work start and end, and many years you've been doing it, and when you want to cease employment. But importantly, if you are retiring early, it's a case of figuring out, okay, is it worth keeping the contributions to PRSI going? And if so, is there a tax efficient way to do that? Will we generate a small income via pensions to keep that contribution going and to use our tax allowances and bands? Again, all of this stuff will feed into the overall big picture planning. Also, be sure to follow up on any state pension entitlements from abroad. So for argument's sake, the gift horse that has been the HMRC top-ups in the UK, that window apparently is still open till April 2026, so a couple of months really. So get on that if you are eligible and if you have yet to do so, and explore whether it makes sense for you to pull the trigger and make the investment to top that up or not. And it is obviously dependent on you living to recoup the investment and then some, but quite an awful lot of people are finding that the payback term is much, much shorter than investing in solar panels or something for that matter, environmental considerations not being factored, of course, right? But quite often the payback on that HMRC is in and around a year or two, depending on the class that you are deemed to be under. But accurate planning, needs accurate data. So getting those figures correct makes an awful lot of sense. Some pension moves to consider for a 2026 exit. And again, this is all very individual, but some high-level thoughts. AVCs and top-ups, right? If your pension is behind target, or if you've not maximized contributions and you have the ability to do so, AVCs, additional voluntary contributions, can be a very useful tool to get money into your pension, therefore hopefully increasing the value of it and the amount of tax-free lump sum you can get and income you can draw in future, while also claiming tax reliefs that you're eligible to. Contribution limits for personal contributions depend on your age, of course, but if you're between 55 and 59, you can contribute up to 35% of your gross income and receive full 40% tax relief on that contribution. If you're 60 on or older, this increases to 40%. So very, very generous limits. If you have cash on the sidelines and you have an opportunity to get tax relief on the contribution, doesn't always, but can make sense to maximize these. the maximum allowable figure for income, and again, we've spoken about this before, but for clarity, the maximum allowable figure for the calculation, so at 35% of your income, maximum allowable salary is 115,000. That's it. Even if you earn 215,000, you will only get the tax relief on your percentage of 115,000. So if you're age 55 to 59, the maximum personal contribution from you, separate to any employer contributions to schemes, so maximum personal contribution from you, whether that's to your main scheme, PRSA and or AVCs, is 40,250 euros in that year, on which you get full 40% tax relief. Okay, so it's really, really super. So in around 17,000 relief if you contribute 40,000. The timing of these contributions often matter. Okay, so make sure you're tying in with your accountant or planner or advisor to get those right. Pension tax relief is linked to the tax year. Okay, so if you're business owner, employer contributions to your scheme need to be done in the year. Okay, if you miss the deadline, the opportunity is lost. Many people, so from back on employee perspective, many people delay decisions until December and then rush through poor choices perhaps. But again, it's all based on the business and the cash flows and what's available, etc. But planning early in the year gives you far more control and time. From a personal perspective, if you're completing Form 11, for argument's sake, right, self-employed income, so whether you are actually self-employed in terms of you have a business and or you have rental income over certain amounts, then you'll be completing a Form 11. You have until October, November, depending on how you're doing it this year, 2026, to make a personal contribution to pension and to reduce the tax you have to pay on your 2025 incomes. So you're doing your tax return this year for last year and settling that. And if you're completing the Form 11 yourself, you'll have a heck of a job running the revenue calculator tool around personal contributions to pensions in the Form 11 system. So give yourself plenty of time to figure all of that out. Lump sum strategy. Most retirees are entitled to take a tax-free lump sum. But what you do with that lump sum can affect your long-term outcomes. Some people use it to clear debt, others build cash reserves or invest outside pensions. And the right approach and whether to take it or not really does depend on your wider financial picture and your plans and your needs, right? We did do an analysis several years ago about whether it makes sense to take the tax-free lump sum or not. And it's quite marginal. Again, depending on lots of things. So around investment returns, how long you live for, etc. Importantly, when it comes to investment risk or volatility of your investment assets, when to start dialing it up or down as the case may be. But as retirement approaches, your investment strategy may need to change. We often see people who have been members of pension schemes and accumulated significant numbers for many years, but have never received specific advice or guidance on the investment approach they have been taking all those years. It was kind of just set it up and away we go, and might make a couple of adjustments, but really not in a very strategic manner. And there are others that are very strategic and have got tons of advice. So it's a very, very individual thing. But some people, for argument's sake, for example, are invested in an annuity lifestyle kind of a strategy. Google Informed Decisions blog 249 lifestyling if you want to see our piece around lifestyling. But we see people who are in that kind of a strategy, for argument's sake, and for example. And that kind of a strategy assumes, and it was based on whatever that individual ticked or whatever they were told to tick years and years ago. But that assumes that the individual will buy an annuity with the pension value upon when they get to their normal retirement age of the scheme. The investment profile there automatically changes dramatically to help them arrive at the point of retirement with their pension almost entirely invested in deposits, money market funds, and bonds. And this might make sense if they are actually going to hand all of that money over on a given point in time to buy an annuity. But it will make very little sense and will be at high risk of ruin if they don't choose an annuity and instead continue to invest those assets for, please God, the next 3, plus decades. So, and vice versa. Some people are invested in a high volatility approach, but have not thought fully through their navigation of market corrections, particularly ones that might coincide with their intended pension lump sum withdrawals and future income generation. And again, and if they might be thinking they're going to buy an annuity. So it's important to get these investment strategies correct. Devil is in the detail. So ultimately, there's a bit of work in that, right? Some people are all over that and love doing that themselves, and others are like, whoa, no, this is not for me. No thanks. They might need help. Okay. There's also the consideration around, now again, we see different people taking different approaches here. And I think this is a wonderful thing to consider. Do you want to step back from employment entirely, or do you want to have a kind of a phased withdrawal, as it were? It's a part-time or consultancy income. And again, you might be able to line that up with your existing employer, or might be through relationships that you have that you can line that up. We have some people who are non-executive directors, they get those roles, and that's a really nice transition. Not specifically that, but is there other employment? Do you go and do a bus driving license, or truck driving license, and head across the continent, driving 1 week a month? Or there's lots of different ways that people can go and do this. And so it's about, okay, what do you want to do? Earning even a modest income in if you're early retiring can significantly improve the sustainability and the enjoyment and confidence to exit fully. For example, earning 25,000 per year, for argument's sake, part-time could reduce pension withdrawals by roughly 2,500 to 3,000 gross, depending on your tax rates and other incomes. But that can drastically improve and extend the life of your pension funds and increase the probability of leaving a legacy in future, and reduce stress and increase enjoyment potentially. Other people are like, get me out of here. I just want to go and chill and decompress and, do whatever it is that I want to do. Then more power to you. But it's thinking about those things. There's no right or wrong here. It's thinking about those things. A simple retirement checklist for 2026 that I would encourage. Update and get the updated around pension statements and strategies. Do that this month, all right? Particularly if you're going to go and talk to a planner. State pension record check. Again, within 30 days, go on to mygov.ie and request your PRSI statement. Build cash reserves if you haven't already done it. Can you focus on that as well as balancing your maximizing of pension contributions? Review your investments. Again, that's a big piece depending on your plan. So your plan should inform your investment strategy of your pension and other assets, I believe. Update wills and beneficiaries. Again, potentially a big piece of work, but get that started. Make an appointment with an appropriate solicitor or advisor. But there are some of the key things to get your ducks aligned. Get those little ducks in a row that I think would be helpful. I have hopefully done that. Oh God, it still took 20 odd minutes. I do apologize. So much to say, so little time to say it, or something like that. I do hope that was helpful. I hope there's a nugget or two in there. Give you a little nudge, even if you're not thinking of retiring in 2026. If you're thinking towards the future and your next chapter, hopefully there's something in that little nudgeroonie that will give you a helping hand over time. Thank you very much indeed for listening. As always, you're a legend.